the business world, numbers and statistics provide a concrete foundation for decision-making and projecting future trends. In commercial real estate, there are myriad numbers to remember, but one stands out above the rest: size. Size matters for several reasons, including scalability, law of large numbers, efficiency, and higher potential revenues. As the primary driver of market valuation and investor sentiment, the size of a property or portfolio carries significant weight in determining an asset's viability as an investment. The role of scalability in commercial real estate. In business, the concept of scalability refers to the capacity of a company or system to grow and adapt with increasing demands. In commercial real estate, scalable assets allow property owners and investors to remain flexible in response to market fluctuations and pursue growth opportunities aggressively. On a macro level, scalability gives industry players the latitude to create value for stakeholders through expansion and expedited project execution. On a micro level, it permits landlords, tenants, and investors to tap into the inherent potential of a property or portfolio. By investing in scalable assets, commercial real estate players can remain competitive and dominant in the marketplace. For example, a retail space may be divisible, allowing a proprietor to rent different segments to multiple vendors or expand as their business grows. Similarly, a large office building with configurable floor plans can be tailored to a variety of tenant needs, helping to attract a diverse tenant mix and reduce the property owner's reliance on individual tenants. Furthermore, scalable infrastructure ensures that properties can support tenants' evolving business requirements while minimizing downtime and capital-intensive renovations. The law of large numbers. The law of large numbers, a statistical axiom dictating that large sample sizes can paint a highly accurate representation of a population, applies to commercial real estate in several ways. One of the main implications is economies of scale. Larger assets often present an opportunity for property managers and landlords to reduce operating costs associated with the property. This effect occurs through the consolidation of expenses, such as property management, maintenance, and repairs, allowing property owners to achieve lower per-unit costs and improved profitability. In turn, this can attract investors seeking assets with a strong history of cash flow and stable returns. Additionally, real estate players that cater to expansive markets, such as international investment firms and major developers, can leverage the law of large numbers to reduce risk in their portfolios. By diversifying their investments across various asset types, locations, and sizes, these firms can better insulate against market fluctuations and swiftly adapt to shifting trends, ultimately protecting their bottom lines. Efficiency and production size also plays a role in efficiency and production within commercial real estate. Assets with larger floor plates, higher ceiling heights, and more extensive on-site amenities can accommodate higher occupancy levels, improve circulation and property access, and generally cater to a broader range of tenant needs. In turn, this can result in lower vacancy rates, longer lease terms, reduced tenant turnover, and ultimately, increased profitability for property owners. Additionally, developments that incorporate elements such as mixed-use facilities, multimodal transportation access, and green technologies can present even more efficiency gains. These larger assets can often achieve much higher returns on investment by appealing to rapidly evolving tenant preferences and market demands. Higher revenues. At its core, commercial real estate is an industry predicated on revenue generation. As a remarkably straightforward equation, greater square footage equals higher rental incomes. Size in commercial real estate is directly correlated with revenue potential. With larger properties comes the opportunity to charge higher aggregate rents, and in turn, generate stronger cash flows on the investment. Financing options will often be more favorable for larger assets, as lenders typically look to risk-adjusted returns and asset quality when vetting loan applications. In the complex world of commercial real estate, one number reigns supreme: size. Size promotes scalability, enables risk mitigation through the law of large numbers, augments efficiency and production, and ultimately drives higher revenues in the market. For investors, developers, and industry stakeholders seeking long-term success in commercial real estate, understanding and prioritizing the role of size in decision-making processes is vital.